I run research and the Global Standards Mapping Initiative at GBBC. We have run a working group over the course of 2025 focusing on tokenization and custody. And it's my pleasure to be joined today by the co-chairing organization Moody's Ratings, represented by Malik Faizullah, to discuss our report and the tokenization life cycle that we have put together, and also the latest trends on standards and risk mitigation. We are also grateful for the contributions of our co-chairs Rajiv Bamra from Moody's Ratings as well, John Lee from Accenture, and Deborah Algio from Zodia Custody. So, Malik, I'll let you introduce yourself briefly. Please tell us your role and your main area of focus.
Hey, Diana, great to be here. I'm going to introduce myself as a blockchain survivor. I've been operating in and out of the blockchain arena for close to a decade now. So I've seen a lot of ups and downs, a lot of launches and cliffs, and I've got the scars to prove it. And now things are becoming more real, and that's why I'm really excited and looking forward to this session. I'm Malik Faizullah, Head of Digital Asset Technology at Moody's Ratings, and I've been at the intersection of data, risk, and emerging technologies for a while. And I lead Moody's Ratings technology strategy and execution as it relates to digital assets and blockchain technology.
Wonderful. So throughout our journey as a working group, we've provided a comprehensive and multi-stakeholder analysis on how real-world assets and traditional financial instruments are being represented on blockchains through tokenization. We also explain custody frameworks to ensure secure, compliant safekeeping of tokenized assets. And we've developed a step-by-step guide to the tokenization life cycle, explaining what happens at each stage, the considerations for business value, and standards and regulations to adhere to. And ultimately, we've also provided industry recommendations for institutional adoption of tokenized financial products, drawing on definitions, use cases, and risk considerations for institutions. So starting our discussion today, I want to start with an overview of tokenization and considerations for institutions. So first, what really is tokenization? And one thing that we explored as a working group is kind of a lack of harmonized taxonomy, as is the case in the industry as a whole. So tokenization, I can start. According to the International Capital Market Association, ICMA, tokenization is defined as the process by which real-world assets are turned into something of digital value called a token, often subsequently able to offer ownership of parts of this asset to different owners. According to the Organization for Economic Cooperation and Development, OECD, tokenization also is defined as an asset tokenization involves the digital representation of physical assets on distributed ledgers or the issuance of traditional asset classes in the form of tokens, and so on. There's many definitions. Ultimately, tokenization essentially means using blockchain infrastructure to buy, sell, move, and trace tokens, which represent rights to any asset tokenized. And our intent with the report, the landscape, and the resources we've provided at open source in our GSMI website is to provide a useful tool and insight for institutional decision makings. We started with this unified vocabulary. We focused on use cases for real-world financial market infrastructure, and we hope the conversation continues. So, turning it to Malik. As traditional financial institutions and infrastructure providers begin operating directly within blockchain networks, what does that signal about tokenization's maturity as a layer of digital market infrastructure, and what still needs to happen before this becomes truly foundational?
Yeah, thanks for that, Diana. And you talk about signals. So let me share some signals as of spring 2026. And this is based off of our own Moody's ratings internal dashboards, as well as other publications. So the total crypto assets market cap exceeded 2.36 trillion USD. Total stablecoins market cap exceeded 314 billion USD. We had 19 new stablecoins launched in 2025, and studies project that the aggregate value of tokenized assets growth range upwards of 2 trillion by 2030. So clearly, this institutional activity tells us that tokenization has moved beyond the purely conceptual stage. It is now being tested in real workflows, whether it be issuance, collateral movement, post-trade processing, payments, liquidity management, and asset servicing. And this is meaningful progress, but I wouldn't equate adoption with foundational status yet. Foundational infrastructure has to work across jurisdictions, custodians, settlement assets, and legacy systems. So for it to be foundational, I think there are three major things that have to happen. The first is infrastructure needs to scale and converge. And so pilots and isolated networks are great and they can show efficiency gains, but foundational infrastructure only emerges when the digital rails connect cleanly to existing market plumbing, and they also hold up under volume and stress. So this infrastructure scaling and convergence, number one. Number two, the legal clarity has to catch up with the technology. And for tokenized markets to scale, participants need confidence in legal ownership, settlement finality, custody rights, and enforceability across borders. So there's been progress that has been made in this area, but there are still gaps around redemption rights, asset backing, and supervisory alignment still limit how far institutions can move core workflows on chain. And the third area is greater risk management integration. So as more value moves onto digital rails, operational, cyber, and execution risk become central. So the foundational adoption depends on monitoring, controls, governance, and resilience being designed into the infrastructure itself. They're treated as integral components as opposed to add-ons, right? So the institutions will only scale usage when these risks are predictable and manageable.
So there's a huge opportunity, essentially, with tokenization to bring capital markets on chain with a series of opportunities. And wow, Malik, you and Moody's ratings have so much data that who better than you to really find the signals and test the trends and see what's really happening. It's really incredible. So we're seeing tokenization expand from equities and funds to fixed income, including crypto collateralized structures. So which asset classes do you see as the next frontier, and what does this mean for risk analysis when the collateral itself is a digital asset?
Yeah, great question. And as you correctly described, tokenization is now moving beyond simply representing the existing securities and into reshaping how collateral itself is mobilized in finance structures. So this next frontier is focused more about bringing illiquid or operationally complex assets into programmable collateral frameworks, particularly private credit, structured finance, and collateralized funding markets. And what we're already seeing through structures like Bitcoin-backed CLO that we've rated is that once the collateral is digital, the analytical lens shifts quite fundamentally. And this focus shifts from whether the value exists to whether that value can be realized under stress within a defined time horizon and through a specific execution channel. So this has a few implications here. The first is that collateral has to be monitored continuously. with digital assets, value can move quickly. So the analysis cannot rely on periodic valuation points. It has to be continuous. And then the second aspect of it is liquidity becomes a much bigger part of the analysis. So the question is not just simply what the collateral is worth in normal markets, but what it can be converted under stress, right? And the third part of this is the structure around the collateral itself becomes critical, right? It's just not the collateral itself, but the structure. That includes custody, liquidation mechanics, execution timing, governance, and system resilience. They all affect whether the value can actually be realized when it matters. So both our stablecoin methodology and emerging regulatory frameworks reflect that same shift. They effectively anchor the analysis on the quality and behavior of the underlying pool and the robustness of the surrounding ecosystem, rather than just on the issuer alone, right? So it's looking at it much more holistically and in an ecosystem view because of the dependencies.
That is fascinating just to see the level and scale of efficiencies that tokenization can bring when we see it as part of market structure too. And there's a lot of excitement and a huge opportunity, as you mentioned, for collateral movement, from efficiency and automation of moving collateral to market access, optimizing capital compliance, inventory management, DeFi opportunities, and the list goes on. Collateral management being basically the underlying assets, as you said, used for backing and often pledged as security to reduce credit risk in financial transactions, and how both the payment and asset representation roles of tokenization can feed into collateral management, providing a whole wealth of benefits. So if we narrow into that for now, as tokenized instruments take on more complex collateral structures, how should custody standards evolve? And what role should independent third-party oversight play in validating those arrangements?
Yeah, I think for custody standards to evolve, there has to be an acknowledgement on the realities and unique characteristics of digital finance, some of which are it's 24/7, for different infrastructure and technological components. There are different types of digital assets and blockchains, and that the assets held in custody aren't always held passively, right? They can be used for collateral, for staking, etc. So custody in tokenized markets have to address these areas. And it's more than just private key safekeeping, as sometimes custody is often equated to. It has to cover additional areas like segregation, wallet governance, key recovery, cyber controls, legal ownership, operational resilience, and the certainty of execution, and which essentially means the ability to act under stress environments. And again, this is very visible in both the Bitcoin-backed CLO rating and in our stablecoin rating methodology, where the presence of a regulated custodian and the verifiable reserve segregation is a key ratings driver. So custody standards must evolve to consider the role of qualified custodian and how that maps into the digital space. And we are seeing this laid out in new regulations such as the Genius Act, right?
Yeah.
So the regulatory focus is now extending to permissionless networks, and where traditional custody models do not fit cleanly, the market still needs equivalent safeguards like governance, validator diversification, reconciliation, and business continuity. And so when that's established, this is where independent third-party oversight becomes critical, because their role is evolving from safekeeping to validation. It's confirming that collateral exists, is unencumbered, and can be mobilized in line with the structure. So in that sense, they are becoming the on-chain equivalent of trustees, but with an added technical dimension.
Right, right. So tokenization's use and expansion, as you mentioned, it really requires reliable custodians and transparency of backing. And it's so important to think of how the shift to tokenized systems requires also new contractual agreements to define custody, ownership, and control of digital representations of assets, and how existing legal frameworks sometimes may lack provisions for storing claims on distributed or blockchain-based infrastructure. So another intent of the report has been to assist institutional compliance and policy teams in a structured way to align internal controls with emerging expectations around tokenization, securities treatment, and custody requirements. And we assess the number of regulatory frameworks, guidance, and global standards. So Malik, one of tokenization's promises is that trusted data can be embedded directly into digital assets, enabling real-time automated decision-making and potentially also regulatory technologies. How does that change the risk management workflows for institutional participants, and where do the practical limitations still lie?
Yeah, it certainly is one of the more transformative aspects of tokenization, and that is that data is no longer external to the asset. It becomes part of the asset itself, or becomes very close to the asset and by living on chain. For example, at Moody's, we launched a token integration engine called TIE on the Canton network. And TIE is a blockchain agnostic solution to interact with digital asset data and publish our ratings on chain. Now, ratings on chain effectively shifts risk management workflows, or has the potential for shifting risk management workflows from periodic reporting to more real-time continuous monitoring with live inputs that can drive triggers, eligibility, and margining in real time. It essentially compresses the loop between risk identification and risk action. So beyond ratings, we're seeing a growing range of data embedded or directly linked to tokens. And some examples that we've seen are reserve composition and attestation data for stablecoins, NAV and valuation feeds for tokenized funds, LTV ratios and collateral metrics for lending structures, real-time pricing via oracles, cash flow performance data for private credit and receivables, and identity and compliance attributes. So all this data can be incredibly valuable, but as volume and velocity increases, the effectiveness of the underlying data foundation still remains. So our stablecoin rating methodology explicitly highlights data quality, scope, accuracy, timeliness, and verifiability as a rating constraint, meaning that weak data can cap ratings or require additional structural mitigants. And it's really important to understand other limitations that are equally important, because the system is only as strong as its inputs. So Oracle reliability remains a key vulnerability. Off-chain data like legal rights and asset ownership, that still requires traditional validation. And lack of standardization across platforms create friction. So these are all off-chain inputs that also play an important role. And regulatory approaches are gradually reinforce this by requiring robust systems to ensure data integrity and reconciliation between on-chain and off-chain records, and highlighting that automation does not eliminate the need for control frameworks. They're absolutely critical.
Mm-hmm. So we're seeing how the nature of risks shifts, right? Bringing novel issues that need new approaches toward risk mitigation. And as we unpack this whole data and data standardization concept, because ultimately the data is going to be behind the justifications of the best solutions, and also behind assessing the nature of the problems, right? So when we see that a truly network agnostic financial infrastructure implies that the same analytical rigor must hold regardless of the underlying chain, so it doesn't matter what blockchain I use, like we're ideally applying the same risk approach. How should the industry think about standardizing data integrity and analytical transparency across both public and permission networks and everything in between.
Okay, so chains can differ, but the fundamental analysis remains the same. So whether an asset is on a public blockchain, a permission network, or a hybrid model, institutions still need the same core information, which is the legal issuer, asset identifier, ownership record, payment events, collateral status, data provenance, and audit history, among other lifecycle events. So there is definite benefit to standardizing some of these critical data elements, common definitions for collateral, valuation, and verifiable provenance, or adapting data standards to accommodate the new realities of a multiple blockchain environments. And Dan, I heard you talk about the taxonomy and creating some of those standardized the nomenclature or the standards in how these are defined. That goes a long way. Another example is digital token identifier, the DTI,
Exactly.
which uniquely identifies the digital token on a blockchain. And the DTI allows for differentiation of the security if the asset is tokenized on multiple blockchains, right? So this is, again, a new standard that's developing to uniquely address this situation of an asset being issued on multiple blockchains and to be able to uniquely identify that. So from an analytical and a transparency perspective, clear methodologies that can be applied regardless of whether the asset sits on a permissioned or public chain, that will go a long way. Both our stablecoin rating methodology and regulatory developments point in the same direction. So if you combine standardized data schemas, if you have independent verification layers like oracles and attestations and interoperable reporting frameworks, I mean, these are all contributing to that degree of standardization and trust in the interoperation of various systems. Now, the goal is that an analyst doesn't have to reinterpret the risk depending on the chain. The data should be economically consistent and comparable across environments. So the ultimate goal isn't really to make each network look identical. That can't happen, right? But we'll have differences in networks. But the goal here is for having consistent identifiers and perhaps other data related to the life cycle events to be consistent across different infrastructure. So in that way, the analytical consistency in that evaluation is a much more achievable and consistent.
Yeah. So really important takeaway for this conversation is that we've really moved past the initial rhetoric of like public chains and private chains, one being safer than the other for certain use cases. We really have so many blockchains out there, and we really need to have a consistent risk approach regardless of the structure of the network. And it all goes down again to the data. So my next question is, as we reconcile on-chain transaction data with off-chain legal and operational records, this is important because when we tokenize an asset, we still have the physical asset changing hands, right? So this requires a parallel system of the movement of the actual asset and following that movement on the blockchain and making sure that those two remain consistent across the board for the purposes of trust, right? So reconciling those two records remains a big friction point for institutions. And as you mentioned, the identifier of the token and then the actual underlying asset, right? How does the industry close the gap? And what does it mean for trust in tokenized markets if it doesn't close this gap? The worst thing we want is for like the blockchain to say, oh, the token belongs to someone when it actually doesn't, and the sale has already occurred and it belongs to someone else, right? We want those two systems to be parallel and to function well.
Yeah, you've hit on one of the most important trust questions in tokenization, because a blockchain can record a transaction, but the question is whether that transaction maps to an enforceable legal and operational rights, right? So in other words, on-chain records are precise, it's real time, but for many assets, especially real world assets, the legal and economic reality still sits off chain. And so how do you close that gap? I think we talked about some of that in my previous responses, getting some of these standards and interoperability frameworks in place, but having a clear legal linkage between the token and the underlying asset is super important. Number one. Number two, a reliable reconciliation mechanisms between on-chain and off-chain data. And then number three, to complement that is trusted validation layers. And that could be in the form of custodians, trustees, and auditors. And together they essentially fill that gap between on-chain and off-chain and create that trust mechanism. So our stablecoin rating methodology emphasizes the same. And the integrity of the system depends on the ability to verify that the on-chain representation accurately reflects the off-chain reality. And that's, again, supported by reconciliation processes and auditability. That can vary. And I think new technology is coming into the fray in terms of how to better make that linkage. But I think it's a combination of standards, technology, and other trusted players that will address that particular gap. That technology aspect of it can address the gap, like I said, through identifiers and standards, oracles and bridges, and other messaging solutions can interconnect blockchain and link on-chain and off-chain sources. And if the gap is not closed, though, the risk just doesn't become operational. It becomes a trust issue because markets are relying on this mechanism to be able to link on-chain and off-chain. And if we can't get there, markets may function technically, but investors will question whether the token truly represents what it claims to represent.
Right. Right. So now as we go into trust and standards and what we need really for this to take off, we've seen that a big barrier toward institutional adoption has been lack of regulatory clarity, which hopefully now we are getting to in the United States and many other jurisdictions around the world. So what regulatory clarity is most urgently needed for risk frameworks to be applied consistently across jurisdictions? And alongside, hand in hand, how should standards bodies also engage with incumbent analytical institutions like you in shaping that agenda?
Yeah, it's a very complex, as you, I'm sure, can attest to and have experienced, and your members, it's very complex. There's a lot of moving parts and interdependencies. I think regulatory clarity is achieved when it's viewed holistically and it's applied across the entire asset lifecycle with an understanding of those dependencies. So when we talk about areas such as custody, segregation, redemption rights, asset backing, settlement finality, legal recognition of tokenized records, insolvency treatment, all need to be addressed in a holistic way. And of those, I think there are three standout areas. One is legal characterization of tokens, right? So it can be a security, deposit, or commodity. And what that essentially is that what that token legally represents, because that determines which rules apply and who has rights, right? The second area is custody and segregation standards. We've talked about that, but this is especially in the case of insolvency. And we need to have confidence that digital assets are properly held, they're separated from the custodian's own assets, and protected if a custodian or service provider fails. And I think the third area is prudent treatment of exposures, including capital and liquidity rules. So it's clear guidance on how much financial cushion institutions should hold against digital asset exposure, including capital and liquidity for potential losses and stress, right? So we're seeing that the regulators are starting to propose this principle-based approach, focus on governance, technology risk, and AML, CFT controls. We're starting to see these be addressed with the passage of legislation like the Genius Act and MiCA,
Yeah.
and they're covering topics like asset classification, custody, and reserve management, some of the things that I just alluded to. But I think for analytical consistency, it's critical that standards and bodies work closely with ratings agencies like ourselves and other incumbents. And the objective should be to ensure that existing risk frameworks can be applied consistently rather than creating parallel systems for tokenized assets, right? These frameworks and methodologies have stood the test of time, and
Yeah.
it's about evolving them and being able to apply them in this sort of extended arena. And I think what is really encouraging is that there is a willingness of market participants to come together, and analytical institutions. They're coming together in working groups. They're participating in industry use cases. They're organically surfacing these key topics and points of view on standards and engaging regulatory bodies in a proactive way, and providing that view of what practical market realities are and what the standards are that make sense. And I think perhaps previously that connection or that might not have been as strong because perhaps there was some fear in terms of acting and not knowing the consequences of those actions. And now I think there is a viewpoint that a lot of these standards and a lot of this feedback will come from the bottom up and through practical use cases and practical implementations, and letting that surface and then engaging the regulators in that way.
This is great, Malik. So finally, as a form of a tool to aid in risk mitigation, mindful of data standardization and regulatory consistency, as a working group, we put together a tokenization lifecycle where step one would be to identify what asset you're going to tokenize and the legal structuring behind it. This would determine how ownership or claims would be represented legally. Step two would be to determine the valuation and the custody, where a real asset is held by a custodian, guaranteeing its security. Then step three would be the on-chain issuance of a token, where a smart contract might mint the tokens and represent assets as or portions of the assets that can be traded on the blockchain. Step four would be the distribution and trading, where investors can trade in these digital marketplaces or use these tokens across DeFi applications. And finally, step five would be any redemption and compliance processes, where issuers may ensure that token holders can redeem their tokens for the underlying assets under KYC and AML and securities regulations in a way that would integrate the functional processes of how tokenization works and integrate them within operations and requirements for financial institutions. Key takeaway here is consistency is key for global markets, because if I tokenize my asset and you tokenize your asset and we're working on different platforms and we don't adhere to similar standards or similar rules of the game, we may hinder interoperability. So we cut off the opportunity that everyone's so excited about to get to a place of a truly global marketplace with a truly global liquidity pool where assets can trade and move seamlessly across borders. So the role of data is paramount here. And I want to end this discussion asking Malik for a key takeaway. And I'll ask you here, you've described a lot of opportunities, a lot of risk mitigation measures, a lot of data considerations on tokenization. But from this discussion, how would you summarize this? What is one word that would describe the capital markets of the future as enabled by tokenization?
Yeah, the word I would use is resilience, Diana. And I use this word because, as I had mentioned in my introduction, I've been in this space for a while. And for those of us who have been in this space for a while, we've seen the evolution of, a technology that was once written off and never thought to be scaled at the enterprise level. And through that journey, there has been a lot of obstacles, barriers, tremendous opportunity. But to get to where we are today has required a lot of resilience, right? And there's so many unknowns, such a wide scope of players, technologies, existing legacy models and infrastructure. And we're all trying to morph that into what that future looks like. And that requires a tremendous amount of resiliency and I think optimism as well.
That is wonderful. That's a wonderful way to end this webinar. I'm going to go ahead and thank you, Malik, so much for sharing your insights, and thank you to the entire working group participants, co-chairs, and everybody who was with us along this journey. And thank the audience.